All right, guys. Well, welcome everyone to this workshop. Just to introduce myself, I'm Jack, obviously. I'm in my fourth year at UNSW, studying maths and computer science. My experience with trading is I did an internship over summer at IMC, which is a high frequency trading company, and then I'm going back in Feb as a grad next year. So yeah, I hope you guys enjoy this workshop. So just for clarification, you can ask questions throughout the workshop if you want. I can't guarantee I'll get to them all, but I can try my best. If there are any big holes I miss or anything that needs explaining, I'll try and get to that. Let's get stuck into it. All right. So, purpose of this workshop, what we actually are going to be doing. Going to be talking a bit about what actually happens at a high frequency trading company, like how they do their stuff, to the best of my knowledge, of course. Starting about how the financial markets actually work. So, if you go to buy a stock, who are you buying it from? Like, how does that work? Who's it coming from? Who sets the price at which you're buying it? What if no one actually wants to sell it to you? That sort of stuff, etc. Giving insight into the life of a trader. So, if you have any questions about things like what actually happens at a company or all that sort of specific company stuff, we might be able to do that towards the end. And then have a bit of a talk about how Python is used on a day-to-day basis by the traders. So one thing I want to sort of make clear at the start is at most of these firms, there's sort of like a distinction between the traders and the developers. I know most people here probably do computer science, given it's CSESoc. And I do myself, but I worked as a trader as opposed to as a developer. So the developers are usually using things like C++, and even some people do like machine language with the really hardware techie sort of stuff. But the traders themselves are more using Python sort of for like analytics and that sort of thing, as opposed to actually writing the code that's going to be implemented and actually making the trades. That's all done in C++ by the developers. So today we're going to be talking about how traders use it. All right, so what's on the agenda for today? We'll start with an introduction to what market making is, which is a common term thrown around with trading companies. Talk a bit about the order books. That's how trades are actually executed on the order book, on the exchange, what is stored on the exchange and how that works. Valuation, so how products and like stocks and things are valued at these companies, which is quite different to how you might learn if you did like a finance major. You'd be doing things like adding up assets and all that sort of stuff. I've got no idea how that works, but I know a bit about how it works at trading companies. We're going to try and do a bit of a market making game. We'll see how that goes. And then we'll go and do a bit of Python at the end. I've got a Jupyter notebook, which we'll have a look through. Cool. So what is market making? When I started like interviewing at companies and stuff, they kept being like, make a market on this, or give me a market for this number. And I was like, what the hell does that mean? And turns out it's literally just giving a price at which you're willing to buy and a price at which you're willing to sell. So it's literally that simple. But with a lot of like the interview sort of questions and a lot of the ways that we learned it, it was making a market on some sort of like common number. So, there were those stupid questions like how many windows are in Sydney? I think I got asked at one time, like make a market on that. And so you got to give a price, like a price you're willing to buy at, which is slightly lower than what you think the actual answer is, and then a price at which you're willing to sell, which is slightly above. So then you can buy low, sell high. Okay, so what market makers do is they constantly make markets. So they're finding prices at which they want to buy and prices at which they want to sell, and they're just publishing them constantly. So people come and execute trades against them, but these market makers are just constantly publishing these prices so that if they give a price they want to buy at and the price they want to sell at, then they make money from that spread. There you go, they profit from the spread between their bid and the offer. So obviously they have to be pretty good to get their bids and offers at accurate prices. Otherwise, people might just keep buying from them if they have like a shockingly low price, and then they'll just lose a lot of money. So they actually have to make sure that they're valuing the things correctly. Cool. So this market making versus position taking, this is sort of like the difference between algorithmic trading and like hedge funds, I suppose. So we say market makers like to have a flat position. So by position, I sort of mean if you buy something, you want to sell it straight away. So with the whole concept of making a market, you're putting a price at which you want to buy and a price at which you want to sell. And then if someone sells to you here, you want to buy it back immediately to make sure that you have the flat position. So they don't attempt to sort of like predict the price movements, because if you were predicting price movements, you wouldn't want a flat position. You'd want to have some sort of exposure. So you'd say, I'm going to buy heaps of this stock and just hold it and hope that the price goes up, and then you'll sell it back later. Whereas market makers don't do that. They're like, okay, if I've bought something, I want to sell it straight away. There's the concept of hedging, which we won't get too stuck into, but it's sort of like buying one product and then selling another product in order to flatten out your position, as opposed to buying and selling the exact same thing. Sometimes, different products have overlap, and then you can buy one, sell the other in order to reduce that. Yes, there you go. If you take a position, you're making predictions. So, places like hedge funds and investment banks might be doing this, where they go, okay, I think this little stock's going to go up heaps, so I'm going to buy it, and hopefully it goes up, and then I'll sell it, make some money, which is a lot of guesswork. Just hard to do. A lot of people think they're very good at it, but not many people are. Okay, so the order book. This is where the trades actually take place. So when we talk about bids and offers and making markets, they're put into the order book. Okay, so it stores all the market orders. So you go, okay, I have a bid here and an offer here, and then it gets chucked into the order book. And then we have the concept of passive and aggressive orders. We'll get to an example in a sec, so this makes a bit more sense. But the idea is, if you have a passive order, you've just published a bid and offer out there. So you've got a bid and an offer. That's just sitting in the market waiting for someone to come and buy or sell from you. So aggressive orders then either buy from your offer or sell to your bid. So let's say you've got a bid and an offer. You've got a bid at 10 and an offer at 15. So you're willing to buy at 10, sell at 15. And then someone comes in and aggressively buys from you. Then that's an aggressive buy. They'll buy from your offer of 15 and then sell to your bid at 10. Hopefully that makes some sense. Sorry, I'm just reading this question quickly. If a trader has stock valued at $10 and willing to sell for $10, and there is a buyer willing to buy for $8, how will the transaction occur and at what price will the stock? Okay, so hopefully this next slide will make that a bit more clear. Sorry, the slide after this one. Okay, so we're talking about order book priority. So this is the same concept on topic of the order book. If I have a bid at 10 and then my friend Joe has a bid at 10, who gets priority? Actually, moreover, if I have a bid at 10 and Joe has a bid at 8, who gets priority? And it's just like any sort of auction, highest bid wins. So I get priority. My bid at 10 is up there and his bid at 8 is below mine, and they're both stored in the order book. Obviously, I have to pay a bit more, but there's obviously a reason I'm publishing a slightly higher bid. Okay, here, so we're talking about price time priority. So the first is the price. The highest price on the bid is the best bid. And then if we both have the same bid, it's whoever gets there first. So if me and Joe both want to have a bid at 10, whoever gets there first gets there first. There we go. Just a bit of explanation about that. And you can put in different types of orders, of passive orders as well. So you can put in a bid at 10 and be like, I only want it to stay there till the end of the day. So when the market closes, can you cancel that order? And usually they're even shorter than that. You might go only 5 minutes. Or you might go, if the stock moves by this amount, I want to get rid of it because it might mean that I have some exposure. So there are different parameters you can put into your order in order to alter how long it stays in the book and what reasons it stays in the book. And you can also like manually cancel it as well if you need to for some reason. Cool. Okay, so here's an example of what the order book might look like. So you can see we've got the bids and the offers. So the best bid we say is 21. So whoever is person A is willing to buy at 21 and person Z is willing to sell at 23. So you can also see that person Y is at 23. So they obviously got there later than person Z. Also, just on the question of slides being available, I think I'll make these available afterwards, but Michael and Colin probably know a bit more about that. Okay, so we're going to go through some examples. So let's say the book is like this at the moment, and then someone comes along, person E has a bid at 19, Where do we think that might go? If anyone has an answer, just like put like between, if you think it's like over here, put between Y and X. Does anyone know where a bid at 19 might go? Between B and C. Awesome. 2 from 2. Yeah, so between B and C, 19 is between 18 and 20, slot straight in there. Cool. Did that go? Here we go. Awesome, so there we can see it. It's in there between B and C. Oh, this is a bit annoying. There we go, okay. Now there's an offer at 25. Same deal, where would that go? Above A. Okay, so so the answer, some people have it, X and W is correct, above W, below X, yep, all the same thing. So I can see someone said above A. That would be the right idea if it was a bid. So if it was a bid at 25, yep, it would go above A, but also there would be some overlap with the offers. So actually in that case, if it was a bid at 25, a trade would actually occur. We won't get into that though. Right now, I've stuffed up these slides a bit, but there we go. Okay, bid at 22. All right, anyone got an idea on that? Bid at 22. Also, we can see that F's now in here at 25 below X because it came in after this 25. Above A, on top, awesome. So G is now the best bid. So we commonly talk about the best bid and offer, or the BBO, best bid offer, being the top of the bids and the bottom of the offers, or the top of the offers, I guess. So there it is, G's up here, 22. G's 22 up here, that's the best bid, and here's the best offer. Okay, now H comes in with an offer at 22. What do we think is going to happen? Where's that going to go? All right, we've got trade above Z, above G/Z, gets matched and they disappear. Awesome, that's exactly right. Trade G, yeah. So a few of you have said it. It goes in and it says, okay, well, we've got a bid at 22. An offer's coming at 22, so they're happy to trade. Both parties are happy with that. They trade and they go. And then the book looks like this again. So there we go. The top one's gone, and we're, oh gosh, left with 21 on the best bid and 23 as the best offer. There we go. Trade occurs. H and G trade, and A becomes the best bid. Cool. Do bids and offers have to match exactly to execute? So if there's like significant overlap, they can execute. So if someone comes in with a bid of like 30, I believe they trade with Z. So this could differ between exchanges, but in the most part, they'll trade with Z because they go, well, this guy's got the best offer. So he or she should get the ability to trade. So they will trade at 23 instead of at 30. Do bids and how many orders would there be approximately per minute? Per bid? How many bids would there be per minute? So it really depends on the market. So on the product. So if you're trading Apple stock, a lot. If you're trading some penny stock that no one's heard of, not many. When the numbers I saw, like on the best bid and the offer, there'd be maybe like a couple of thousand, but it can be more. James, you've preempted the next slide. We'll get to that in a sec. No, that's right. So I think there were some products that I saw trading had like 25 million trades in a day. And by 25 million trades, 25 million volume. So we'll get to volume in a sec. But some would be a lot lower depending on the liquidity, as we say. So liquidity is basically the number of people, the amount of activity in the market. So if there's a lot of activity, if a lot of people care about the stock, the product, then it's going to be really liquid, like Apple or Google or whatever, Amazon. But if no one really knows about the stock, it's not very liquid. Okay, are bids and offers independent of the actual value of the stock, or does the transaction result in the value of the stock? Well, this comes down to what do you mean by the actual value of the stock, right? So this is how people are valuing the stock. when you go on Google and you say, what is the value of this stock? Like what is this stock's price at the moment? You will get a summary of the order book. So that's basically a valuation that Google will do for you. At this stage, it would probably say 22. This stock is trading at 22. So the actual value of the stock is completely determined by the market participants. So like by the people putting out the bids and putting out the offers. And then is there ever a time that you would bid higher than the lowest offer? Well, if you remember when we were talking about passive and aggressive traders, you wouldn't necessarily put a bid in. You might aggressively buy. So let's say you independently came along and you said, this stock is like, this is some company that I really rate. It's a small tech company and I think it's just incredible. It's going to go take off. So I think it's actually worth 40. All these people trading in the 20s and teens, I think it's worth 40. So then you can come in and you go, okay, well, I'm just going to buy all these offers. And then you can put in a bid higher than the offers. So you might go, I'm going to buy everything and then I'm going to put in a bid at 30. So I hope that answers your question. But hopefully we'll see some more examples in a second. Okay, so volume. This is basically the same, very similar to what we just had, but we've got these new columns on each side of volume. So this literally just means how many do you want to purchase of this stock. So you can see up the top on the best bid, we've got order G, person G, is willing to buy 150 lots of this stock at 22. And on the other side, person Z is willing to sell 100 lots of this stock at 23. So then, I think James mentioned this earlier, what happens if an aggressive buy order comes in for 400 lots? Anyone want to have a guess as to what would happen? They've come in and they've just gone, I want to buy 400. Actually, I'll put it this way. So 400 is in dollars or volume. So sorry, 400 volume. It's an aggressive buy order. So it depends on the offers that are already sitting in the book. They're going to go, I'm going to buy from these offers. Okay, cool. ZYX settled. So that's exactly right. Next person said ZY and part of X. You're close. There we go. ZYX and partial F. Cool. Max out the lowest offer available, then buy next cheapest. Yep. You're all on the right track. Someone said the price will move to 28. Exactly. Okay. You're all saying similar things and you're right. So what is going to be, can someone tell me what's going to be on the top line after this trade occurs? After this order comes in, what's going to be on the top, on the best bid? Best offer. F. Yep. Order F. 20 volume of F. You guys are good. Cool. 20 F and then 300 at 30 after that. So yeah, this comes to the previous point, like what happens if a huge order comes in? So this would probably rarely happen, but it would happen if someone's really confident in how they value the stock. They think it's worth heaps or they think it's not worth much. So if this person who's coming in for 400 lots better know what they're doing, because otherwise they're pretty exposed. So this is when we talk about having a flat position or not. This person, assuming they're flat now, they buy 400, they're very exposed. So they'd want the stock to go up. But also, you know, if we're just observing the market, we're not participating, we're just observing, and then we see this happen, we're going to go, okay, there's something interesting about this. Clearly people are undervaluing the stock. We've got to change how we value the stock, and that sort of stuff gets pretty interesting because you're watching what's happening in the market, and that's informing your own opinion of what the stock is actually worth. Okay, so I should probably go to the next slide. There it is. Cool. So I think all of you said that. 28.20 at F. Adrian, is it possible to see the live trading table for a public company which has this info? Look, I've tried searching for that before and I'm yet to find it. Luckily, I was able to see some of this stuff when I was interning over summer, but I've never really been able to find it online. And like a lot of the companies you go through, if you go through a broker and those things, then ComSec has this. They might. I'm honestly not sure. Then a lot of the things you can see is just like the price of the stock, as opposed to the details of the order book. I'm sure you can get some sort of subscription where you can see this stuff, because I've been really curious before and like playing around with some sort of like really simple trading bot to see if you can exploit this stuff. I'd probably lose money, but it'll be interesting. Okay, so now we come to valuations, which we sort of discussed before. So when we're back at this stage here from this order book, we're probably valuing the stock between 22 and 23, right? That's the best bid and offer. Pretty simple. You're going, okay, it's somewhere between there. That's probably what we reckon the stock is. And then this happens, right? This bloke comes in and buys heaps of it, and you go, okay, now I'm changing my valuation. It could be close to now like 25, 26. You might think that this person's just a crazy person, so you're keeping it down towards 22, 23. But what informs those valuations, I guess, is the question. Honestly, if I had an awesome valuation, then you'd make a lot of money. So yeah, valuation attempts to find the true price. And so we say HFT is high frequency trading, or algorithmic trading, some people like to call it. The valuation is usually calculated from the order book. So that's what I just said. So you look at the book, you see all these bids and offers, and you go, okay, I'm going to value it around here, in between these bids and offers, as opposed to maybe like hedge funds, people that think they can predict the stock market, that calculate it based on a hunch. Yeah, so value, okay, and then once you have your valuation, then you go, okay, now I will make my market. I will give a bid and I will give an offer. Of course, it's almost a bit circular if you're saying you're going to value it from the order book, and then you're going to make your bid and offer, because then you can just go straight to what the best bid and offer is. So you want a pretty good algorithm in order to be able to do both at once. And then this is an important point here. The more confident you are in your valuation, the tighter the spread of your market. And by the spread, I mean the difference between your bid and your offer. So if you are like super confident, like we had the example before that you think this stock's worth exactly this much, you're going to put your really tight bid and offer, like here you're going, it's worth exactly this much. And there's my market. And then hopefully lots of people trade from you, and people like sort of agree, or people sort of, tend towards your market because yours is the correct one because you're very confident. Then you're going to get lots of trades around here and you're going to make a lot of money from the spread. If you weren't confident, right, and you still had a tight market, like let's say you're tight down here and everyone's trading up here, but you've got a tight market down here, everyone's going to go, who's this silly person putting offers down at $5? I'm just going to buy heaps from this person. And so people just keep buying from you and buying from you and buying from you, which means you're selling low, and then you're going to have to buy high, which is the opposite of what you want to do. So if you're not confident, you give a hugely wide market, right? Wide market. So everyone's trading around here, and then you give a market like this. So bid and offer. So you can't really go wrong. But the problem is people aren't going to trade against you because you're giving a really low bid and a really high offer. So everyone's like, I don't want to trade against that. This is why you need a good valuation, so you can actually make trades, and you have to be confident, so you have to be right, so that people actually trade against you. Cool. So this is a mid-market valuation, is the middle of the bid and the ask. Very simple. So before we had a bid at 22, offer at 23, your valuation would be 22.5. Advantage, it's very easy to calculate. So if, obviously, when you're writing these sorts of programs, time is of the essence. This is very quick. Disadvantages. Can anyone think of any disadvantages of simply taking the middle of the bid and the ask as your valuation? Incorrect valuation. Yes. Why? What's bad about it? Changes all the time. Okay, here we go. Cool. Doesn't take into account variation between bid and offer price. Could be skewed. Yep. What if the stock is very illiquid? That's a very good point. So there might not be many people trading this stock. The market could be really wide. Let's say the market's like 20 at 50. Someone's bidding 20, someone's selling 50, and you're valuing it at 35, right? And someone comes in, they're a bit more confident. They go, okay, I'll put bid and offer 25 at 30. All of a sudden, you've traded against someone, and the market's not very liquid. There aren't many trades you can do to get out of your position. So you want lots of people trading it. Could have been a temporary movement, exactly. Outlier bids can throw off the valuation. it depends which bid. So we're taking the best bid and best offer. So if there's an outlier bid, it's probably going to be one that's a few levels deep, so not actually the best bid. If the best bid is an outlier, then you've got a wide market. So disadvantages: doesn't give any indication of the width of the market, which is sort of what we just said about the liquidity. Doesn't consider volume. So you could have heaps of people on the bid and no one on the offer, and then you've sold to the bid. Sorry, what did I? Yeah, and then you're pretty exposed because then the price is going to go up. So if there are lots of people on the bid, no one on the offer, you'd expect the price to go up, right? It's demand and supply almost. Supply and demand. What is liquidity? Sorry, I'll go over this again. Liquidity is basically the activity of the market. So how many people are in the market? So if there's heaps of activity, lots of trades happening, lots of volume on the bid and the offer, then it's very liquid. If there's like no one really cares about it, it's not liquid. So liquid stocks would be things like Google and Amazon, etc. Whereas illiquid, not liquid markets would be stocks that none of us have heard of. How would high volatility affect mid-market? Well, with this sort of stuff, volatilities. Oh, actually, I guess so. It's the idea of the best valuations are ones that preempt a move in the market. So before we had a bid and offer 22 or 23. Let's say that some trades happened and then it moved to 23, 24, right? You'd been valuing it at 22.5, which is now outside the best bid and offer. That's not good. You basically want to have a valuation that will tell you that the price is going to move. So it could be because there are lots of people on the bid and not many on the offer. And you go, okay, I think this is about to jump up. So let's move our market. And then while everyone else follows, we got there first. So we've done lots of trades and we've made money. So I guess volatility would affect the mid-market because it means things are moving around a lot and your valuation isn't preempting those moves. If bid and offer do not equal, how do you determine the best bid and offer within a time period in order to determine the mid-market value? You don't want the best bid is literally just the highest bid and the best offer is the lowest offer. And there will almost always be a bid and offer. I haven't seen anywhere where there's not been a bid or an offer. I'm not sure if that answers your question. This next one, we're going to talk about does consider volume, reverse weighted spot. So it's basically a weighted average using the volume. It's easy to calculate again, and gives a reflection of the volume on the best bid and offer. So let's say you had 10,000 lots on the bid. So there were heaps of people that wanted to bid. There were 10,000 people bidding at 10. And then there was one person on the offer at 20. Logic tells us lots of people want to buy. This stock's probably worth more than where it is now. So your valuation is going to be like 19.9 using this method, which could be good because then you go, okay, well, it's pretty high. I think the market might move soon, so I'm going to move my market. Cool. Disadvantages. Can anyone think of any disadvantages? So this is, again, a weighted average using the best bid and offer. So instead of just taking the middle of them, it weights it based on how many are on the bid and the offer. No indication of width. That's true. Yep. Again, doesn't give width. In fact, there you go. Well done. Gives no indication of width of the market. There's one other thing that's important as well. Well, probably a few other things, but one other thing I can think of. And that's that you can't see further levels of the market. So we keep talking about the best bid and offer. There's a second best bid and there's a second best offer. So let's say we come back to our similar situation. You've got 10,000 people at 10 and one person at 20. But then after 20, you've got 50,000 people at 21, right? So your valuation's gone, heaps of people want to buy, not many people want to sell. So my valuation's like 19.9, but turns out at 21, there are 50,000 people that want to sell. So now your valuation doesn't look so good. It needs to be lower. So these are all things that you need to consider when you're creating this sort of valuation. Yeah, because the person that's put the offer at 20 is what's called diming. So before, if you remove that 20, we've got 10,000 at 10, 50,000 at 21, and then someone's just come in and put one lot at 20 to get on the best offer. Yeah, so this person answered, it doesn't consider other bids and offers. Exactly right. Cool. Okay, so now we're going to try and make some markets. I hope this works. It could be a bit of fun. So I'm going to get people in a second to make some bids and offers, and we're going to try and trade against each other. So the problem is I tried to come up with some numbers that people can't Google. So when I did this, we did a lot of this with the internship where we'd make markets on things like how many trees are in this place, how many presidents has the US had, things like that. And we just had an honest system where people can't Google. Sadly, I don't trust everyone here. So the first market we're going to make, so the sum of the ages of everyone in my immediate family. So I'm deliberately not telling you how many siblings I do or don't have. And then my parents, the recording will be available, yes. So add up all the ages of how old you think people are. And then I want everyone to give a bid and an offer. So right now you should be coming up with a valuation, right? Now we just spoke about some valuations that use the current orders that are in there. So now we don't have any orders in there. So you're going to have to come up with a valuation. Think about how many people do you think might be in my family? What are their approximate ages? What do you think it would be? 140, okay. Is that a bid or an offer? 120 bid. So one question I'm going to ask is, do you think we're going to have a very wide or a very tight market? Wide. Yep. Wide. Awesome. Because there's a lot of uncertainty, right? I could have 0 siblings. I could have 10 siblings. They could be really old. They could be really young. There's a lot of uncertainty here. So given that, there should be lots of wide markets. How does bid/offer work? So what is a bid and offer in this example? So someone gave before a bid of 140. Someone gave a bid of 120. Okay, here we go. I'm going to take Isaac's example. Bid 140, sell 176. So that's pretty tight. But the advantage of having a tight market is 140 at 176. There might be a lot of people willing to buy at 176 and a lot of people willing to sell. Sorry, 200 and 240. Buy at 240, sell at 200, which means you make a lot of money from the spread. Okay, cool. I'm getting lots of interesting markets. So the sum of everyone in my family. Okay. So 2 parents, me, and then potentially some siblings. Okay. So I'm going to choose one of these markets. I'm going to choose Isaac's because I called that one out first. So I'm going to make the market is going to be 200 at 240. Right? Okay, 200 at 240. So now I want everyone to write down, based on a bid of 200, an offer of 240. Do you want to buy or sell to Isaac? You can either buy at 240 or sell at 200. Sell. Okay, lots of people selling. Everyone's selling. Okay, so just to clarify, this is where it gets confusing. Isaac's got a bid at 200, which means people are selling to him and he is buying. So everyone is selling at 200 and a few people are buying. Okay, cool. So awesome. And now wait, so it's the sum of all the ages of family members, the bid or the offer. Well, that's think about like a stock, right? It's like we're valuing a stock. You're valuing this sum. So yeah, ideally, yeah, the sum equals the price. Sorry, this does. I remember when I first did this got very confusing. But the sum is the price. So the price that we're looking at is the sum of the ages. And the best market will have the correct answer in between their bid and their offer. So if 200 at 240, which is what Isaac said, if the answer is between that, then he's going to make a lot of money. In fact, he can't lose money. And no one else can gain money. You sell if you think the age is lower, you buy if you think the age is higher. Exactly right. It's buy low, sell high. Okay, cool. So I want everyone to write down what trades just happened. Isaac, you got a lot of people selling to you, so you've bought a lot. So Isaac's bought at 200. A lot of people have sold at 200, and then a couple of people bought as well down the bottom. Okay, so write down what trade you just did. And now I'm going to give some information. We're going to make a new market. Okay. So now I'm going to tell everyone I have 2 siblings. And that's true. I have 2 siblings. And now I want someone else. I'm going to choose someone else's market. So now make a new market. You should be more confident now. You probably have a tighter market because you have more information. So can anyone give me a new market? 140 at 180, 180 at 140. Okay, lots of them coming in. Cool, cool, cool. Okay, these all look pretty reasonable. Cool. Actually don't know what the answer is yet. Cool, cool, cool. Okay. I'm going to try and find a tightish market that we can do. One at 20 up here. Okay. So, okay, I'm going with Lydia's market, which is bid 160, sell 180. Bid 160, sell 180. So now everyone choose, do you want to buy at 180 or sell at 160? Sell, lots of people saying sell. A couple of people saying buy. Oh, okay, good. There's actually a good combination of buying and selling. Okay, similar number of people buying and selling. What does that tell us? If there are some people, like, let's say it's half, neutral. Let's say it's half buying, half selling. What does that mean? Great market, exactly. Close to true price. Fantastic market. In fact, it could be totally wrong, but it means everyone's totally wrong. So it's a great market. So Lydia, you've made a lot of money there. And also, remember, everyone's done 2 trades, right? So a lot of people before sold 200, right? Sold 200. Now, if you were risk averse, you would have just bought at 180 there and locked in $20 profit. So you sold 200 and then you buy back at 180. Awesome, made $20 profit. Unfortunately, Isaac's very exposed. What is the actual answer? We're getting there. Other words, could you say that the buy price is what you think the minimum age of all family members? Yeah, exactly right. That's right, Adrian. Minimum, the buy is the minimum and the sell is the maximum that you think. Okay, cool. For people who sell twice, do we assume some short selling here? Yes, exactly right, Tyson. So short selling. So if you've sold twice, that means you've sold at 200 and you've sold at 140, which means you're very exposed. So if the answer is above 200, you haven't made a lot of money because you've sold low and now you're gonna have to buy high. I'm gonna figure out the answer because I don't know the answer. Just trying to think of my parents' ages. And okay, so the answer is 187. So let's say I'm going to take the example of people who sold 200 and sold 140, and then they buy back at twice at 187 because they've sold twice. Now they buy back twice at 187. Have they made money? 180. So they've bought at 187 twice, and then they've sold at 200 and sold at 140. So they've lost $34. Yeah. So you notice that Lydia's market was actually wrong. Well, when I say wrong, it didn't encompass the correct value, but a lot of people traded against it. So she still made lots of money, which is great. So tight markets can be good if you're close. Is the best market always somewhere in the spread? Yeah. So the best market will contain the value in the market. Yeah. Because how does volume come into play? Oh, so we didn't consider volume in this example. What is a correct value? A correct value is in real life, there is no correct value, right? In this market, there is, but in real life, there isn't. We assume everyone buys a standardized volume 1 unit. That's exactly right. That's what we're doing. Yeah, so I hope that made some sense to people, what we did there. I know it gets a bit confusing. It would be nice if I was like having a whiteboard or something, but I don't have one of those at the moment. Cool. So yeah, so it was a great market by Lydia, even though it didn't contain the value, it was still a great market. So a great market then could have been something like 180 at 200. Let's say I'd got 180 bid, 200 offer. There's no way I can lose money from that, from people trading, because either I'm selling high or I'm buying low. That's awesome. Can't lose money, and no one else can make money. So in this example, we're only having one bid and offer, and everyone else is aggressively buying and selling. So it's not exactly what happens. You know, if you were in real life, you'd have the opportunity to jump on the best bid as well, or jump on the best offer. But this is just sort of so we can see some examples. Tighter is better. If you are confident, it is better, yes. So let's say somehow someone here knew exactly the ages of everyone in my family, or knew that I have 2 older sisters and knew their ages. Then they could have given a very confident market at the start. But at the start, no one had any information. So there were lots of different markets. Like, so I saw someone like below 100 and then some above 200 and stuff. So at the start, I honestly thought the markets, if anything, were too tight. So a tight market means that the difference between offer and bid is low. Yeah, so they're really close together. If you have a wide spread and someone has a tighter spread that is completely within your spread, doesn't that mean no one will trade with you? Yes, it does, Isaac. Which is why you want to be confident. You want to be right. Like if you like, I could give you a wide spread right now on Google stock. It's not useful, is it? Because no one's going to trade against me. So that's why I guess you have to know what you're doing. And if you have a good valuation, you'll make money because you'll be on the best bid and offer. The risk of market making here is that once you have successfully bought, immediately the price moves to a new range out of your original bid offer range. Yeah, that's right. So the market moves, obviously, and the idea is that you can preempt those moves based on your valuation, which is really like very short-term prediction. And we all know that predicting the stock market isn't easy, is it? Does a tight market reduce the risk of everyone buying from you or everyone selling to you? Yeah. Well, actually, no, not necessarily, sorry. You could have a super tight market that's just way off. If you have a tight market that is reasonable, then yeah, it reduces that risk. The different is, it isn't necessarily the width that reduces the risk of everyone doing one thing, it's the accuracy. How does one find such information in real life for trading? Usually inside information, if only. So we could sort of say that this market we just did was synonymous with like someone, like you're trading some stock, some company, and then their warehouse explodes. And you go, well, okay, we've got to change our prices. When I revealed that I have 2 siblings, you go, okay, that's my information. I'm going to change my market now. Or you could go, you know, this company just realized it was sitting on this huge oil reservoir, and you go, well, they're going to make a lot of money. So you move your market. So that's sort of what we're trying to mirror here. Cool. I do have some more examples. I'm gonna jump ahead and get to the Python bit because this took longer than I expected. We can trade those after if we have time. So Python, getting on to actual Python. What do traders do with Python? We've talked about all this stuff. What do they actually do with it? So they look at the past trades. So they can see throughout the day, what did the order book look like for the last 3 hours? What did our trades look like? What did our valuation look like? Were they right or not? Test what would have happened. So if we changed our valuation, we went through a mid-market valuation and a reverse weighted spot valuation. What if, usually they're a lot more complicated. There are like heaps of other parameters in there. What would have happened if we slightly changed those parameters? Would something have happened? Did we notice a trend where we could have changed a parameter in order to take advantage? And test out new valuations. That's the same sort of thing. What if we tried this valuation instead? And look at trade data, what trades did and didn't occur and why. So, we might have wanted a trade, but we weren't quick enough or something like that, which is often more a challenge for the devs who are writing the actual code that's executing the trades. But you can see what trades we wanted and what we got. Okay, I'm going to jump over now to a notebook where I've got some stuff that we're going to go through that looks at what we just did. Okay, I'm going to stop share and then reshare. Share again. Where is it? There it is. Share. Cool. So hopefully you can see a Jupyter notebook on your screen now. If you can't, please let me know. That's just one question. What's the difference between preempting the moving of the market versus timing the market? Thanks, Michael. Not really sure what you mean by timing the market, but preempting the moving of the market means sort of if there are lots of bids and offers and then, there's more volume or more pressure on one side, you might go, I think it's about to move, which we're actually going to get to down here. Okay, so we're looking at pandas. I won't go into a huge depth with the syntax I'm using here because I presume a lot of people here have Python experience. But pandas is something that I used heaps over summer, which was really useful. It basically lets you create these huge data frames, which I'll show you in a sec. So all I'm doing is importing it. It's taking a while, that's annoying. Reading in some stock data into a data frame, which looks like this. So that is gross, right? There's a lot going on. But hopefully these middle two columns at least make some sense to everyone. We've got the best bid and the best offer. So here the best bid is 1,023.5 and the best offer is 1,024. And then if we go to the left, we can see the next best bid just below, not far below, and the next best after that. So we can see 3 levels deep. And on the offer, we can see the best offers here and the volume on each level. So there's a best bid of 1,023 with 107 volume. Now note this 107 volume could be comprised by multiple people. There could be someone with 100 lots in there and another person with 7 lots in there. But you don't always get shown that. Sometimes this is the most data you'll get for an exchange. It depends on the product and depends on the exchange. So this is data for 2 minutes. 2 minutes? 1 minute 40. It's 100 rows. And we see the market every second. There are multiple bids and offers going on at the same period of time. Yeah, heaps of bids and offers going on at the same time. We've just been looking at the best bid and the best offer, which are these ones in here. But there are lots of other ones. So if the market moves, these people are already in set position, right? Which is something we haven't really spoken about. But these people might have actually preempted the market move over here. They might have gone, oh, the market's about to go up. Here's my offer. And the market moves and they go, you beaut, I've made some money. So that's why we have to consider these people in our valuations as well, right? That was one of the limitations of those valuations we saw before. They only looked at the first level. But what about these people? What if these people know what's going on? Do you always place a bid and an offer? Well, it sort of depends what sort of trading you're doing. If we're talking about market making, then yeah, that's what market makers do. They're bidding and selling. But if you're looking to take a position, you probably don't care too much about a 50-cent difference. So you're willing to buy the offer. So one other thing I'll note is with certain exchanges, you can see the status of the book. So this is the status of the book right at exactly 10 o'clock market open. This is what the book this is what the book looks like. And then 1 second later, it looks like this. Another second later, it looks like this. And so when I was trading, I was trading on the career desk. And so we saw market snapshots every 400 milliseconds. So we'd see a new set of these every 400 milliseconds instead of every second. I know on some other exchanges, you can see it every time it changes, right? So in this second, the book might have changed, it might have gone up and then down. Or it might have just stayed the same, might have gone up heaps, down heaps, we don't know. But in some markets, it'll tell you every time it changes. This is just some random data I've made up. Okay, so what we're doing is we're going to do our mid-market valuation, which we discussed before, right? So what I'm doing is I'm taking the data frame we just had, and I'm only getting these columns. So basically a subset of the data frame, just these two columns, and then copying it over, and then putting in a new column, mid-market column. And this is the thing about pandas. Look how easy that is. You just get all the bids and all the offers, add them up and divide by 2, and it gives you a whole new column. Where is it? Down here. So I rearranged the columns as well. So it was actually in the middle because that's where our valuation is between the bid and the offer. So here we go. This is our mid-market valuation. Very simple. 0.75. That's between 0.5 and 0.0. Pretty straightforward. Cool. Then we'll get to the RWS, so the reverse weighted spot, which we said considered the volume. So what I'm going to do is same get a subset of the big data frame that we had up here. But this time, I'm not just getting the bid and the offer. I'm getting the bid volume and the offer volume. And we're copying it. Here it is. I've already done that. And then we're going to assign a new column to the data frame, right? So I did a similar thing up here. Can we get a link to this Jupyter notebook? Yes, we can. After the session, yeah. So we've got, wait, sorry. Yeah, so we're assigning. So up here, we assigned a new column like this, bid plus offer divided by 2. This is basically allows you to do more complicated functions. I actually don't even know if I need the lambda here, but there it is. So we're assigning an RWS column, which is our new valuation, which is going to be in the middle. It's going to look like this, but instead of mid-market, we'll have RWS. And this is the formula for the RWS. So this is the weighted average we spoke about before. You have the bid times the offer volume plus the offer times the bid volume divided by the total volume. So this weights it towards the bid or offer. So here we go. Let's try and find a good example, like down here. Okay, let's have a look at the last column. There's about twice as much pressure on the bid as there is on the offer. So our valuation here is skewed more towards the offer, right? More people wanting to buy makes us go, okay, more people want to buy. That's a lot of demand. Price should go up. So our valuation is towards the offer, right? So this isn't very complicated. It's pretty simple valuation, but it gives us some indication of where we might want to trade. And then we're going to use this valuation to make trades. And because we spoke about before preempting the market move, this RWS is always between the bid and the offer. So it's never actually preempting market moves. So it's not a great valuation. If I had a great valuation, then I'd be making money. The valuation tells you where to center your next bid and offer. Yeah. That's a good way of putting it. The valuation tells you where to center your next bid and offer. Yeah. So if your valuation is smack bang in the middle of a current bid and offer, you go, okay, people are valuing this appropriately. This is a good valuation. My bid and offer is just going to sit here. Or it could be like, oh, it's actually a bit above the offer, my valuation. So you go, okay, I think everyone's slightly undervaluing. I'm going to put my bid and offer above where the valuation's in the middle. What kind of platform can we do this without doing an internship? I wish I knew the answer. I'm sure you can do some research and find some ways to do that. I've seen things, a lot of the things unfortunately need US citizenship and stuff, because the US is a lot more set up for this stuff. Yeah. What knowledge did you have when going into the internship? I'll answer questions about like the internship specifically, I think, afterwards. Dodgy markets like crypto, yeah. Okay, so we've got our valuation here and we're going to trade with it. So I'm just copying the data frame across to a new data frame. So copying what we just had across to a new data frame. And what this code is basically doing here is going, okay, get our valuation and compare it to the bid and offer at the next time step, right? So let's take this valuation, and we compare it to the next bid and offer. So we're valuing it here, and all of a sudden the market moves, right? We haven't preempted it. But what we're sort of saying is this new market is wrong. This valuation is right. So we're going to sell to them here. Try and find another example. Where does the market move? Here. Okay, so the market moves down now. And we go, well, this is too low. We think it's actually up here. So we're going to buy here. So we make some trades. I don't have anything here. Let's have a look at what it looks like. Cool. So these are all the trades we did. So you can see here the market didn't move, so we didn't do anything. No trade. Market moved, we made a trade. So this valuation was lower than what we had here, the next bid. So we sold to them. Yep. That was our trade. The negative and positive refers to buying or selling. Cool. And we sum up all these trades we did. So this is how much actually, like the money transaction, you know, we either bought or we sold. How much money was there? Okay, now this is we've lost money, apparently. Anyone have a guess as to why this is so big, right? Because we haven't done, like, all these are pretty similar. All these trades, they're pretty close. So why is it so negative? There are only 100 rows in here. We haven't traded it every time. And if we sell, we're buying back at almost the same price. There's only like 50 cents difference between them. What volume we traded? Sorry, I should have said we only specified volume of 1 here. I've almost given it away in the next one. But basically the idea is that we don't have a flat position here. The valuation is off. So yes, the valuation is off, but that's why it's going to be negative, but it's not going to be this negative. That's not actually how much money we've lost yet. The thing is that we haven't bought as many times as we've sold. So we haven't sold as many times as we've bought. We've bought more. We bought twice more than sold. I don't know if it's exactly twice more. I'd be impressed if that's right. Buys and sells. So this is what I'm doing here. I'm calculating how many buys we did and how many sells we did. So this is a good way of doing it. So basically I'm creating a new data frame in what I've highlighted, which is only those where this column had a negative value. So basically when we buy, we give money to someone else, we lose money. We don't lose money, we give money away. So it's negative. And then when we sell, it's the opposite. So I'm going, how many times do we do those trades? How many times do we buy? 34. How many times do we sell? 30, right? So we still need to sell 4 more times in order to get back to a flat position. Sell 4 more times, right? Which makes sense. 4 times about 1,000, 4,000. Cool. We're looking a bit better now, right? So I'm getting the very bottom of the data frame here. I'm going to say, okay, at the end of this is what our valuation was, right? And we need to sell 4 more times. So let's just suppose that we sold 4 more times at the bid, right? So we sell 4 more times. So we're getting 4 times 1,021.5, right? So we're selling to this bid. So we've sold 4 more times. Only lost $5. Still lost money, but only 5. Yeah, so I guess there are any other reasons. So I should say this is randomly generated data. So anything that you think is different here that wouldn't mirror an actual market that is causing us to lose money. Does anyone have any thoughts on that? What's different about this compared to an actual exchange? the fact that it's random data. Everything about this is pretty random. Trading costs, it's a good point. Wasn't thinking about that, but that's a good point. So trading costs differ. Liquidity, yeah, so the volumes. So no mid or long run trends, yeah. But things. So if you've heard of the concept of a random walk, I'm sure some of you have in probability that the market we sort of consider as a random walk. So we don't really look for mid or long term trends. So yeah, trading costs. So in some places you have like tax when you have to sell in the market. So like in Korea, there was tax whenever you sold something, you had to pay tax on it. Just is annoying. So one thing I was going to say is the bid and offer volume is not indicative of future market movements here, whereas in the real life market it sometimes is. So in real life, you have huge pressure on the bid, then the price is going to go up. But here the volumes are just random. So when we have a valuation that's pushing us in one direction, it's not necessarily accurate. So I guess the idea is up here, if you could alter this, where's this function? This function, which is basically get a valuation to preempt the market movement, then that's great. So you could say something, a simple thing could be if the difference, like this is pretty close to the offer, you might say if this is within 0.1 of the offer, then we're going to move our market because there's lots of pressure on the bid. And there are all sorts of other things that you could do with that. Yeah, that's all we've got here. I'm pretty sure the thing said 12 to 1, so I'm not going to go into too much more new stuff, but I'm happy to discuss things and answer questions. Okay, a lot just came through at once. I'm going to try and answer. Who guarantees that the trade is successful? Is there a middleman? I'm not sure if you mean successful as in it executes or successful as in you make money. If you mean regarding it actually executing, that's the exchange, the ASX in Australia. That's what stores all this data and actually executes these trades. So, there's the exchange, it's on not Hunter Street, it's off George Street. I don't think it's Hunter Street, it's parallel to Hunter Street. There's the ASX, you can actually see the ASX. And that's calculating people buying and selling and doing this thing. So that's the middleman. Someone said mid-market valuation could be better for this randomly generated data. Yeah, it could. But ideally, like this sort of thing is never really going to be profitable until you come up with a valuation that preempts a market move. Wondering about the impact of market makers on the market. Looks like market makers actually help improve the liquidity of a stock because that's exactly right, Tyson. So they talk about providing liquidity to the market, which basically means, if you want to go and buy a stock, it takes you 0.2 seconds instead of 0.23 seconds. So yeah, they're like in Hong Kong, you can get a lot of data about what's actually happening on who's on the bids and offers in the exchange. And so I saw like a lot of graphics of it, and it was basically just HFT firms everywhere. So they were all on the best bid and offer, and they were like taking up 90% of the best of all the bids basically and offers. And then there'd be like investment banks and hedge funds taking up like 5%, and then like unknown retail traders or random people, like people who just want to go buy some stock. Yeah, and so some people think it's somewhat controversial because they're sort of making a product look more liquid than it should be. So you've got heaps of bids and offers, and people go, "Well, this is really popular. Like a lot of people care about this thing," but it could just be some company putting in heaps of bids and offers, and not many people actually care. You could make a bot and just let it trade, hoping to make money. That would be the dream. Yeah, you could do that. That's basically what HFT firms are. Big bots that trade and it makes money. But obviously you have to be good. You have to know what you're doing. I don't even know what I don't have a valuation that's going to make me money consistently. Or I'd be a millionaire. can you get started trading like this by yourself, or do you have to do it through a company? I don't actually know. I think you can, but it would be difficult based on like fees and actually getting sort of hooked into the exchange. But it's worth researching, because I know some people do their own like auto trading, that sort of thing. So I know it's possible. I just don't know how, sadly. I wish I did. Oh, Michael said there's no constraint. Cool. All right, well, I'm happy to just keep answering questions. And if people want, we can also go back to trading those other markets if people want to do that, if you enjoyed that before. Just let me know in the chat if you do. Is stochastic processes required knowledge for graduate and junior traders? So just in regards to, okay, I can see there are a few questions about how much I knew. Those two questions there. I had no finance knowledge. I know stochastics isn't necessarily finance, but I didn't know anything about finance. I knew like what an option was, and like that wasn't even expected when I got there. Knowing this sort of like order book stuff and like how to make what a market is, I guess would be helpful, because like that sort of stunted me a few times. I was like, oh, what do you mean by that? And they're like, oh, I'll just give like a bid and offer, and I was like, oh, okay. And I didn't really know like why I'd chosen that, and like why I'd made it tight, or why I'd made it wide, or things like that. But like they don't expect you to know that. They have very few expectations on your actual finance knowledge, and like this, like not many people know the details of this stuff, because it's sort of HFT specific, I suppose. Stochastic processes. So I have never done stochastics. I know what a stochastic process is, but it's about it. So yeah, you really don't need much knowledge to be a junior trader. I went in with maths, 3 years of a maths degree and not much knowledge. But also the biggest thing with these companies is that they want an interest. So I got turned down by a few because they said, look, we didn't think you were interested enough. So having sort of something tangible that you can say, this is why I'm interested, like here's some proof that I'm interested, is really helpful. So if you had something like a trading bot, they'd be interested in that. But I sort of was just like, oh, I am interested. You have to believe me. So that's something that I would definitely address if you're going into interviews and that sort of thing. How can we go further than this workshop? It's a good question. Honestly, the way I learned the most was doing interviews. Obviously the internship, but like doing interviews helped me a lot. There's a lot of info out there on this sort of stuff. I'd say like if you could find a way to make a trading bot that actually trades, that would be pretty cool. Like that's something that I would love to do if I had the time and resources. Well, not really need the resources, but yeah, that would be cool. Is HFT for sole traders, or do we need to be part of a big company or part of a company? You could do it by yourself. It'd be risky, but you could. Doing it with the company is obviously a lot safer. Not necessarily easy to do, but if you're doing it by yourself, like, and you make money, then that's impressive. And you make money by yourself, then you can create your own company. But it's hard. Turns out I may have bought and sold to market makers. Yeah. How much of an impediment are transaction costs for HFTs? Not much at all. So if you're doing it through ComSec or something, you're paying broker fees. A lot of that stuff, I believe, I don't know the details of this, so I don't want to talk too much to it. But my understanding is with HFT firms, they're sort of like directly hooked into the exchange, so they sort of bypass a lot of those transactions. So a broker is sort of like a middleman for you, between you and the exchange, whereas these firms sort of just go straight to the exchange. So transaction costs, except for those imposed by the exchange, yeah. If you place a lot of bids and offers, doesn't trading with yourself sort of cancel itself out? Self-trading is bad. If you self-trade, you can get like in legal trouble. So that's something that you have to be careful about. When during the internship, we did some like auto trading, like a trading simulation, and we were told we get in trouble for self-trading, and it just happened all the time. People kept self-trading because like it's hard to put it into your code to like block against that. But it can cancel itself out, yeah. So you need to be careful about when you're canceling bids, when you're putting bids in, and that, etc. Have you had exposure to mainly options, futures, currency, or equities? So when I was there, I was trading ETFs. So I didn't actually, I did some options theory, but I didn't touch actually trading options where we were doing ETFs, warrants, and futures were the main things. We didn't do a lot with equity where I was. The company does obviously, but I don't know how much currency they do. I don't know the details of it, of exactly what's done at the company, but I was with ETFs. That was my thing. During the internship, did you do more research or hands-on trading? So at IMC, the way they do it is all the interns get to do a project. So it's 10 weeks and you work on a project, which is really cool because the projects are actually things that they want to do. They just haven't had the time or resources to do, and you get a lot of training out of it. So I really enjoyed mine. Mine was using Python, doing this sort of stuff to develop like a dashboard that would display ETF prices. And in the last few weeks, we actually got to make some trades off the back of it, which was really exciting. But a lot of people were sort of doing like research based on this stuff and just going through data, trying to find something. So I was lucky that my project actually allowed us to make trades from it, which was pretty cool. But there's a lot of like training along the way. Like you do a lot of, like you have a lot of talks and like sort of like lessons and things along the way, learning about different parts of trading. Is it advantageous to major in maths as well? To work at a trading firm? As a trader, yes. As a developer, you don't need maths. As a trader, maths is definitely helpful. So of the interns, a lot of us did pure maths. There were some actuarial students. There were a couple there that had finance majors, not interns, but traders. But most had some sort of maths or actuarial background. Like you don't need it. It's advantageous. You don't need it, but like the interviews are sort of like, if you have a mathematical problem solving background, it's helpful. Yeah, someone's going to an HFT firm, have no maths or finance background knowledge, learn that maths required for the interns, but want to be a bit more prepared. Any recommendation of prep or background info to learn beforehand? Anything you wish you learned or knew before? It's not necessarily stuff I wish I knew before, because they really taught it from a very basic level. Like they didn't assume any knowledge, which I thought was really cool. But like we got through stuff quickly, I suppose, because everyone was very engaged. Yeah, I wouldn't say you need like extensive mathematical knowledge. Like the maths, like if you look at the maths we've done today, it's pretty basic, right? The more complex maths sort of comes when you're doing, I suppose, option pricing. So I don't know if you know anything about option pricing. I don't know a lot about option pricing, but we did a bit of training on that. So if you're interested in like getting ahead, I suppose that's what I would look at. Looking at options and maybe black shoals and stuff like that, but like you don't need that stuff. I wouldn't be worried about not having enough knowledge heading into it. Of course, this is only my experience. It could be different at different companies, so I don't want to speak for everything. Would it be better to do a maths or stats degree? Pretty same really. It doesn't really matter. I'm also not a recruiter, I just want to say, so I don't, my answers aren't the final answer. Is there a minimum WAM requirement? Probably. I think some companies do say distinction average will get you in, but I sort of say with this stuff, if you get through like the resume stage, then it's very much up to their testing. So you might get through the resume and get the online test things they send you, and then you get through that, and then it's very much like, I don't think they care so much about your WAM beyond that. It's like your WAM sort of gets your foot in the door, and then it's up to you to do well on the tests. That's my guess. Again, I don't want to speak for every company and every recruiter. Does IMC give interns the opportunity to transfer to other international offices? Not during the internship, but beyond that, I believe so. So I know one guy that I interned with is now going to be a grad in Chicago. So we interned together over summer, and then I don't know exactly what he said, but he's starting in a month in Chicago as a grad, which is pretty cool. So I think there are opportunities. Like all the traders that have been there for more than a couple of years, they say, oh yeah, I worked in Chicago, then I worked in Hong Kong, and etc. So it's pretty cool. A lot of people have been around. So I do think there are opportunities for that. With regards to IMC, our US offices in Chicago. Chicago is the big hub for HFTs in the world, really. Chicago is the place to be. He said to build a bot, but I've also heard that talking about your bots during an interview isn't well viewed by HRs. Interesting. Well, it depends how you talk about it, I guess. If you're sitting there and going, oh, yeah, I built this bot, made heaps of money, like I know what I'm doing, then they're going to be like, who's this arrogant person? Like, shut up. But if you sit there and you go, yeah, I'm interested, I've played around a bit, I'm trying to understand how the exchange works, like I'm really interested to see some new techniques and stuff, then I don't think how that can be a negative thing. I'd be very surprised if that was a negative thing. How do we get real market data for this kind of trading automation? Sort of mentioned this before, I don't really like have a Google for it because, sadly I don't have many like specific links like go here and you'll get this stuff. I wish I did. Sadly, I don't have a lot about that. How does HFT differ between different asset classes? Not really sure what you mean by that. Sadly, sorry. Can you give any tips for people thinking of applying for a graduate position? So I think my biggest tip is to be prepared to explain why you're interested. I know a lot of people have concerns around the technical stuff. And so I think, if you Google like trading interview questions, you'll get heaps of stuff. And different companies do it slightly differently. But the biggest thing for me personally was being able to say why I'm interested in trading. So that's probably my biggest tip. Do junior traders employ heavily quantitative models developed proprietarily by the firm, or is it based on somewhat simple models and then intuition and hunch? They're sort of adapting models that the firm already has, I'd say. So for my project was pretty simple, I'd say. Well, it was very much a new strategy what my project was doing. It was somewhat straightforward given I had the tools already there from the company. So like I didn't have to do a lot of the hard valuation work. Some other people did, but again, like it's sort of parameter changing as opposed to develop an entirely new model. If that sort of answers what you meant by that. And yeah, I guess it is intuition and hunch. Like one of the guys I worked closely with, another intern, he was very much working on evaluation, and there were all these things he'd speak about, and I'd be like, what the hell are you talking about? But all the traders knew what he meant, because it was a very IMC specific thing that they were talking about. So he was sort of playing around with parameters, trying to make this model work for a specific product. And so I guess that was a bit of intuition hunch. Like, what if I try this? What if I try this? What sorts of information do you draw before placing an order? Do you draw from, what sorts of information do you draw from before placing an order? It's mainly the book. There's not, I don't think there's a lot else going on. Do you constantly place orders? Yep. Well, not, but like it's all done automatically. That's the thing, right? So people aren't sitting there manually going, I want to buy here, I want to sell here. It's doing it itself. Yeah. So it's just constantly placing orders. Like I remember I looked at, we had a pretty good sort of widget for the bids and the offers, and it was just changing all the time. Like, and it was our bids and offers going in, like just changing up and down. It's just the computer does it. 2 questions. What do you think about the morality of trading, especially algorithmic trading? Oof. What comp or maths courses in any way, in one way or another, are relevant? What do you think about the morality of the trading? Oof. I potentially you're getting towards the point of who you're making money from. I guess, sure, you're not adding a lot of value, are you, by trading? But it's interesting, and I'm 21. Making money off retail traders who think, just put in stupid prices, I guess, can be easy if you have the infrastructure set up. It's more fun to think that you're trading against big companies like hedge funds and trading and investment banks. What comp or math courses are in one way or another relevant? I don't think there's anything I specifically used. Like, in the first few weeks, what I was sort of like basic knowledge of calculus, or like high school calculus knowledge. That was the most helpful. In terms of comp, I was doing all Python. So I guess algorithms helps with like efficiency, but like I wasn't using, exactly things you're learning in like 3121 or anything like that. I wouldn't say that for me in what I did, at least, wasn't like this subject perfectly set me up for it. It was sort of just the combination of, computer science knowledge and some maths. What's the difference between HFT and options, forex, stocks, etc.? The difference between, like, give me between different companies. So, as in, or maybe how they operate on them. Well, honestly, I haven't spent enough time across different products, so I don't know like much of the difference between like options, ETFs, and stocks, etc. But my understanding is they're traded very differently. So perhaps one thing to look up is the Greeks, which are used for option pricing. They're called the Greeks. If you type in the Greeks option pricing, you'll get some information about how options are traded. Which is a bit different to how stocks are traded. So, they sort of talk about trading volatility, like you're trading what you think volatility is going to be like, which you can do in options, which you can't really do with stocks. Yeah, I don't want to get into too much depth about that. Is honors considered advantageous? No. I actually was meant to do honors next year and was convinced to not do it so that I could start as a grad next year. So when I say convinced, they said you don't need to do honors, and I said, well, I don't want to do it because I want to start. And they couldn't actually offer me a position if I did honors because it was like 2 years out. So I decided to not do honors and then start next year, which they were more than happy with. As in, like, they just, you don't need honors. Like, I know that my mentor there, because everyone gets a mentor, my mentor did his honors in option pricing. It was literally a whole year he did in option pricing, and he said to me it didn't help me at all. So, like, while it's definitely interesting, it's just they do a lot of training themselves. You don't need the knowledge. What do software engineers do at trading companies? Software engineers, they're I guess writing the code that actually executes the trades. So they're probably biggest goal is to make things more efficient. So make it faster, the time between trades, and all the time it takes to execute a trade. And then also like analyzing why trades do and don't occur. So, the traders might go, we want to do this today. Like, why didn't, what prevented us? And then the software engineers might liaise with the traders and discuss like what could change in the models and then that sort of stuff. But yeah, like I'm trying to, because there was like it seemed like the software engineers all did slightly different things. I'm trying to give a good explanation, but they do a lot with the actual traders. Like there was a lot of communication between traders and devs, which was really cool, because they literally sat like just behind us and there'd be a lot of discussion like, oh, can you fix this, or we need to change this, and it would happen pretty quickly. Market making, is that one of the better ways to make money from trading? I'll put it this way, it's one of the ways that I know. You can make so like there's market making and there's position taking. So I'd say market making is a good way to like sort of develop an algorithm with a limited finance knowledge or desire to predict future movements. If you think you're good at predicting where stocks are going, then by all means take a position, see how it goes. I'd say it's a safer way to make money from trading if you know what you're doing. So I don't know what I'm doing by myself, but I know the basics, and then hopefully the company knows what they're doing. Market making doesn't need info about the underlying stock. No, not necessarily. Like I'm sure to some extent it can inform the markets that you make. You could actually, there could be some very important information that does impact it. Oh, and also there are things like, if you're talking about options and futures, they like capital. That's a good one. So sorry, back to Melena's question. Doesn't need info about the underlying stock. So if you're looking at option pricing and futures pricing or any derivative pricing, you need to look at interest rates and dividends. So you do need to have an opinion about those in order to actually form a valuation. So if you look up basic future pricing, the formula is just a linear equation in interest rates and dividends. Is computer science essential for trading? No. So actually, there were 9 trading interns when I was there, and I was the only one that did computer science, which was an advantage for me. What were the most majors? So there were 9 of us. There were 7 pure maths majors, 2 actuarials. A lot of people had double degrees, so I can't remember exactly what they all were, but I was the only one with computer science, which was an advantage, but not necessary. Like no one else necessarily struggled because they didn't have it, but it did help me sort of get into the code, I guess, more easily. Econometrics background at all. There was one guy that does economics. He actually tutors at UNSW. But I don't necessarily think it was necessary, no. Like there are a lot of useful background. There are a lot of useful majors, but there aren't necessarily any that are essential, I guess.
Yeah, hello. Unless there are more questions, but just in case people have to leave, can we all just say thank you to Jack now? Because it's going really well and hope everyone learns a lot. Yeah, thank you, Jack.
Guys, that's right. I hope you got something out of it.
But I'm happy to keep this open if people still have more questions as well.
Yeah, okay. There's one question back there. Let's see if I can find it. Ryan, do you recommend a pure maths or stats major then? I wouldn't choose something like that with the intention of giving yourself a better opportunity to get into a trading company. Do whichever you enjoy more. Like, actually, sorry, going back to what I said about pure maths, one guy I actually think did stats instead of pure maths. He's doing a PhD in stats or something. He's a pretty smart guy. So stats would potentially be more helpful. I haven't done much stats. I've only done 2901, which is the stats course you have to do for maths. So it's really like everyone sort of brings their own niche to trading, I suppose. So I was lucky to have the computer science background. Some people had great stats backgrounds. There was a guy with economics. Someone was trying one girl was implementing like machine learning things, which I'd never heard of, which sounded pretty cool. So again, there's not one that's better than another necessarily. It's just what can you bring, I suppose. Yeah. Cool. Michael, do you want me to send you? I'm trying to think how I can send the Jupyter notebook.
Yeah, sure. You can send it me via whatever, and I can post it on the Facebook group. Or you can do so either way. You're co-host. I'm happy.
Oh, do you want me to send it on the chat? Is that what you're saying?
You can do that, or you can just upload it on Facebook on the event directly.
Yeah, I might do that.
You should be able to do that.
Yeah, I think
either way, I'm fine.
Yeah. Cool.
And the slides are already there. So.
Oh, awesome. Too good. All right, cool.
So thanks everyone for coming. Hopefully you learn a lot. And thanks for Jack. Thanks to Jack for running this workshop.